Right, I think we've probably settled down a bit there on our numbers. So as I say, welcome to the Iress Cashflow webinar. My name's John Bethell. I'm a business consultant at Iress, but my background is very much financial planning, having spent 20 plus years with the National Wealth Manager, which is where I first came across the Iress Cashflow tool as we took it into, anglicised it from an Australian tool and rolled it out into that national business. So today today's really about the cash flow demonstration. It's about bringing cash flow to life and running through the Iress tool. In terms of learning outcomes, we're going to look at a simple client journey. For me, it's really important that cash flow is simple, easy to access and fast to do at a high level, and then be able to move to a more detailed view as required. So get to the detail of the planning if you need to. We're also going to look at an area of the Iress Cashflow tool that really allows you to reflect your financial advice. And I think this is where some of the power of cashflow really comes through to clients. And then we're also going to look at a bolt-on module of the Iress Cashflow tool that allows you to present easily to clients in a live environment, but we also may look at the reporting options as well, just so you can look at either way and what works for you as a business. You can ask questions through the Q&A through the session. In reality, I will probably look at these at the end, but do ask. If I see them coming up through the webinar, then I may pick them up at the time if relevant. So okay, without any further ado, let's get on and look at the tool and see how it works and see how you can maybe use it for your clients. I think the first thing to look at here is that it's an integrated tool. It's very much within the Xplan suite, which will enable you really to get a good idea of how it sits within the tool. Enables you not to have to save things elsewhere as well. So as we can see, as part of the menu, we can get into the tool by going into the cash flow area. And this is a scenario-based tool. So I'm going to build a scenario. In this case, I'm just going to label it test, and I'm going to pick a template. And these templates are really important for you as you build your sort of clients through cash flow, as enables you to set your house settings as a default. You can have more than one, and the great news about that is you can kind of reflect different client circumstances, and this reflects that drive to make it easy for you to run a cash flow. So we'll just go into into a new scenario. And we can see at this stage that actually there is nothing in this area at the moment. So you could build a cash flow totally from scratch within here. However, the recommended route is to use the import wizard. And what this does is it pulls all the information recorded in Xplan. So really looking to have that efficient flow of information, not having to rekey, not having to spend the time or take the risk of miskeying data. And so what we've seen with businesses is that the information in their main system improves significantly over time, which is great from a review point of view and from a compliance point of view. But as that information then gets imported into the cash flow tool, we call it X tools in Iress, but I have control as the user, so I can decide if I just want to import the pensions area or if I want to import everything. And in this instance, I'm going to import everything from the client. And that is our data load done. So when I then now look in the tool, I can see that it's loaded expenses, etc. And if I go down into here, I can see all the information that's been loaded at a glance. So just a very basic client there, some income, etc., etc., etc. So that is my data load, and you can see the time saved that would have over having to build the scenarios individually yourselves. load the information. I'm now going to go back to the basic scenario that I built earlier, so I'll just run you through a very sort of straightforward scenario. So we can see here, it's brought us into this front page, and things that are templated are how long, for instance, do you want to run the scenario for? So we've got age 99 there, age 95 is also common, but increasingly we're seeing the ONS tables, life expectancy tables, being used based on the principle that the FCA is saying advice should be tailored to the client's life expectancy, and an ability to build in some extra room, say +5 or +10 years on that life expectancy. This tool is a full tax calculator, and we can decide what tax locale we're using, whether we're using English or Scottish, and again that can be templated if it's appropriate. We can even switch off the tax. So just running through this this gently, we'll just pick out some areas of note. The tool will do a full basic state pension calculation for you if you don't have a state pension forecast, and just pick it up. And again, this is all designed to be able to give you that quick and easy solution to a cash flow. Running through, we can look at incomes and expenditures. As I say, all this will be imported for us, but we can change it. So once in the tool, if I think, well, actually, I want to model what happens if they get an inheritance in 10 years' time, I can pick up a non-taxable for Fred, and I just put in the amount one-off rather than every year. That's fine. And I can put in a custom date. So again, this has the ability to, instead of just saying it's going to happen in 2030, I can say it's going to happen on the 1st of June 2030. So I can be really precise if I want to be so. Expenses we're seeing, and just to repeat that kind of principle that you can add, change and amend, because once you're in the cash flow tool, you are completely detached from Xplan. I've just added in here, instead of just some standard expenditure, I've added a difference in retirement, just stepping down at retirement and then having some golden years of holidays. Moving through into assets, we categorize these basically into their tax wrappers. As a straightforward explanation. We see here some cash-based, some investment-based, but in here we can also cover VCTs, EISs and CDISs. And we have a couple of options in terms of how we put growth into the tool. Do we use, in the background, we can use system and the risk profiles that are built within the tool, either your own profiles or the Morningstar ones, whichever are appropriate, or within the tool, we can just use with some rates that are built in purely for cash flow. And there are advantages and disadvantages in doing that, and that's something I'd be very happy to talk you through should you want to look at the tool in more detail. ISAs and bonds, etc. Just going through it, it does all the tax correctly, including for bond surrenders across all segments, across the whole bond or across all individual segments. Jumping into the pensions area, we can see here that I've built, we've just imported some values on some pension funds. We've got some growth set there for us, which again we can template so you don't have to add. In the contributions there, we can see we've got one salary of 100,000, that's their pensionable salary, and contribution based or percentage based, or just individual contributions as is appropriate. We do have the option of UFPLS in this area because it comes from uncrystallised funds, but that's just going to give you a standard UFPLS drawdown. Looking at the at-retirement area, again, the tool helps you to do things easily. So here I've built a very simple drawdown, and the reason for that is that I believe firmly, and something I'm going to show you today, is this principle of current position versus a planning scenario. I.e., if the client didn't take any further advice from you, what would happen? What would happen to those client assets? And if we spoke to most of our clients who hadn't had any advice in the pensions area, would probably say, well, at retirement, they take their pension. So what I've modelled initially is a very simple single drawdown, single crystallisation. They're going to crystallise it at retirement. they're going to take it all. They needn't, but they are in this instance, and they're going to take 25% tax-free cash. We could do multiple crystallizations to do a phased drawdown, but that's really out with it today. Having crystallized that and taken the tax-free cash, again, we have an option to set our growth rates, but here I've used a button that works out the optimized amount. What that means is the tool will calculate how much the client can take on a level or index basis, whichever you choose, to take that fund to zero at the end of the scenario, so at age 95 or 99 as selected. So if we think about our needed review time for drawdown cases, then we can actually get that sustainable level of income given the growth rate assumed, and we could just label that drawdown 2020 as the scenario name for compliance purposes. And of course, because of compliance, it's all within Xplan. We don't need to save it anywhere else. So that's what I've done for both of these clients. I've just produced a couple of very straightforward values to show what income they would get. Moving on through the tool, it will deal with the tool will reflect defined benefit schemes and retained benefit schemes, all imports, similarly with liabilities. Again, in the inheritance tax area, we go for the same sort of principle in terms of making life quick and easy should you want to do so. So here you can see I've got set up very simply on death, everything going to the spouse and then to the children. And the children, I've just done a dependent split to say it goes to 50-50 each. Nice and straightforward. If I wanted to get more complex, then I would change that from spouse to custom. And then I can take the time either at the asset level or perhaps more importantly at the individual asset level to tailor that to exactly who I want it to go to, whether it goes to children, whether it goes to charity or whatever, and whether that plan is IHT liable or exempt, to give you the full control of what you do. And similarly with DC pensions, etc., we have the same principle. And so that just reflects the fact that you can very quickly and easily produce an IHT graph that says, do you broadly have a problem? Yes, you do. Do you want to do something about it? Yes, you do. Fantastic. Now let's get to the detail and plan properly and reflect that planning. So for the purpose of today, in this scenario, I'm just going to leave it on spouse and children. There we go. So again, moving through here, in terms of insurance, the import wizard, very much our friend, will pull through all that policy information so we can then start looking at what happens on death and disability. And the key here is getting your information right in Xplan. To smooth that quick and easy route in terms of producing what happens on death, again, we have this default principle where we can decide, where you can decide as a firm, what do you want these assumptions to do. So what we're saying here is on Fred's death, Fred's income goes to 0. Helen's income stays at 100%, and their joint income stays at 100. Again, in expenses, Fred's expenses go to 0, Helen's stay at 100, and the joint expenses go to 75%. And repeated for Helen. So this is all set up, can be set up within your template. So it's just there in the background for you. Very simple to do. So that means you don't have to start allocating things individually. What happens to this on death and what happens to that on death? You just very quickly can get to a chart that shows the position on death. Then if you want to, like with inheritance tax, you want to move forward and go to the detail, we can change from default to by source. And that means you can detail every income and every expenditure individually, what happens on death. And that principle is reflected on illness and on career break, so taking a sabbatical. One of the areas that I talked about in the objectives was looking at the cash flow allocation. And this concept, I think, is something that I, as a planner, would have looked for and did look for in some detail. What this area of the tool does is it allows you to reflect your advice. So here, in surplus, so when the client has surplus income, what does the client do with that income? Where does it go? I would suggest, if they're not taking advice, then this would go to, that surplus would go to one of two places. They either save it in cash, or they spend it. In actual fact, there's probably a third way, which is a mixture of both. They tell you that they're saving it, and then at the end of the year, they do spend it on a holiday, new car, new kitchen, whatever it is. So I've just set it up so that the money will go to cash if there's a surplus. And then we then have the deficit area, which says, well, what happens in deficit? So when the client doesn't have enough money to support their expenditure, typically in decumulation, when they're in retirement, where do we take the money from? And with each of these, we can get to the detail. So I can then define a different area. So if I then look at it and say, well, actually, no, having done my basic scenario, I now want to do something more complex, I could then put in a more complex order. And so I could say repay debt first, then fund pension contributions, then fund ISAs. So we can now start to reflect our advice. And when we're doing that, and we go to the surplus options that we looked at a moment ago, we can see, we can actually specify that actually we only want to pay £5,000 of debt, or we only want to put, and then £2,000 into ISAs and then £1,000 into pension. We can do it by amount, we can do it by percentage of surplus. And this is where, if you want to, you can start really tailoring your advice to that particular client. So it can reflect your financial planning. It also gives them the client the picture of a current position. This is the problem, and then your solution. And it shows the difference in the two is why they should follow your advice. And similarly in deficit, we can select where we draw the deficit down from. So we could draw it from cash, we could draw it from ISAs, and between that and the phased drawdown, we can manipulate that using the personal allowance for 12,500 each year, etc., 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 to be really tax efficient. You'll notice here in this current position, I haven't used the pension funds because I used that grey button earlier that maximised the return from the pension fund, that sustainable level of drawdown. So that's the cash flow allocation tool area. And to me, that is the heart of my financial planning. Given the import that we have, given that all this can be templated, of course, along with the templating for the death and disability areas, etc., it enables you to produce a very, very quick cash flow. And this comes out in three main ways. We have the display screens. There's a whole series of spreadsheets. The benefit of the spreadsheets is you can see exactly what the tool is doing. You can see all the detail of how it's working, what's happening, and areas. If I want to see how that tax calculation of 47,000 is calculated, then we have the detail in these screens here. All the spreadsheets can be exported to a CSV, to a spreadsheet, so you can manipulate them further if you want to. But as you can see, there are a lot of spreadsheets, really valuable for understanding exactly what the tool is doing. We then get to the charts. And I think charts are personal. What do you want? What do you want for your client? And in fact, that last point is probably the most important. What will your client understand? I quite like to start with really straightforward and easy charts. And so I'm going to go to the cash flow net chart. And this one is very simple. I will just take out that that inheritance that he's going to receive. So we get a single spike. It just keeps the graph simple, doesn't it? So we can see here a very, very simple picture that when the client is working, so pre-retirement, they have surplus money coming each year. And you can then have that discussion with your client. What are they going to do with it? We can see a spike here with the tax-free cash coming in. And then once they've retired, they're in deficit, so there's a further need for advice. Very, very simple. And on capital wealth, again, follows that theme of blue is good and red is bad. Assets rise up to retirement. Well, we saw they had surplus, that's no surprise. And then we decumulate over time and run out of money in our late 80s, the client's late 80s. Really straightforward. I could get more sophisticated if I wanted to. As I say, for the right clients, then this is very powerful. And we can see here, it's a bit busier, so I'm actually going to take these out and just say, well, this is the client's income coming in. We can see it coming in, where it's coming from, pension drawdown, and state pensions coming in there. I can then pull in their expenses, and we can see what's going on. There's a bit of tax here, and can we manipulate that out? We'll see. And then capital in, which is, you can see their tax-free cash coming in, and we can capital out. We can see the pension contributions and loan repayments being repaid there. And I will couple that with the gross wealth chart. And this breaks down the client's assets. So we can see here, or the liquid assets, we can see here, liabilities being repaid over time, the pension funds rising up to 560,000, taking their tax-free cash, and we can see the drawdown assets, then a great long tail, because it was that sustainable level of income. Other charts that are used, CALM outflow. CALM stands for cash flow assets and liabilities modelling. Again, we have the same sort of functionality, being able to click things in and out, but what this does is it shows all the outgoings. So again, we can see that little bit of tax being paid. Are there ways of that being modelled out? Just it may be used just as a kind of prompt for us as planners. And we've got the CALM inflow chart, which is the reverse. It breaks down all the inflows coming in. And these are I'm just running through with you the popular charts. So we can see where their income's being built up. We can see here they've got some state pension and that drawdown continuing, but that's not enough to support their expenditure. Very simple, very straightforward. I'm actually going to go back to the capital wealth chart because it keeps it simple. And I'm now going to use some of the levers. I'm just going to increase the growth rate by 2%. That's my version of financial planning. I think yours is far more sophisticated, and what's more, mine's transient, whereas yours stays in place. So we can see here the client now has quite a large surplus, and I just want to do that because I want to take you through a couple of other useful areas of the tool in terms of the calculations. So we can work out, in terms of thinking now about risk need, how much risk does the client need to take? The tool will calculate how much, in this instance, because they're in surplus, how much they'd need to reduce their risk by to take their assets to zero at the end. And we can see they can reduce it by 1.06. And what I've done is I've actually built in a reserve. If I wanted that to start today, then I can recalculate it. So I'm just leaving a £200,000 reserve here because we're looking really to not take it to absolute zero if you wanted to. That said, if I wanted to, I could take that from retirement. The next area I'm going to go to is the actually spending on a regular basis. So how much more could they spend on a regular basis, leaving that £200,000 reserve? And we can see they can spend an extra 18,000, but hang on a minute, I actually know that they had surplus income up to retirement. So let's not give them any more income until retirement, so we can manipulate when the calculation is made. So we can see here that if they started that income, that extra expenditure in retirement, and had £200,000 in today's terms at the end, they could spend an extra £28,000 a year in retirement. That's a pretty good retirement. And similarly, we can do a calculation of how much they could take as a lump sum, either now for gifting or in the future, if they don't have enough money to support their expenditure in retirement. This may be how much do you need to sell your business for at retirement to be able to make the grade. And what that does is enables you to quantify or qualify that statement that we hear very often from people who run their own businesses. My business is my pension. Yes, but how much is your business worth? How much are you going to be able to sell it for? And this tells you how much you need to sell it for to achieve that objective. Clearly, if their business is worth more than they need, then could they consider early retirement? What are their other options? Can they coast into retirement? If, however, they need their business isn't valued sufficiently to be able to get to that point, then maybe you should be challenging them. You have the option to challenge them around, well, actually, it's not going to do the job, therefore should you be going, should be funding more through pensions, or should be working hard? What are your options? So it really opens up that conversation. So let me take you back to the capital wealth chart. I just want to take you through those calculations because I think they're quite valuable. And I'm just going to return that back to standard, and that's what I meant by my financial planning is just transitory. It doesn't last very long, which is why I do the role I do now. So we're back to our original scenario with the money running out in their late 80s. And I said I'd show you another way of sort of adding the value. Very, very quick and easy to do in this tool. And today I'm going to do it live. So what I'm going to do is I'm going to duplicate that scenario. And I'm now going to save as. I'm just going to call this planning. Because I've got planning already. There we go. So I've produced my current position. I'm now going to think a little bit more about what I want to do for this client. So what planning do I want to go for? Well, in reality, what I'm going to do is the first thing I'm going to do is I'm going to what I'll call auto ISA. So I'm going to say to the tool, we had a GIA there, general investment account, and I'm just going to get the tool to auto fund ISAs. Now, in today's environment, taking money from pension perhaps is a lower priority. You want to try and preserve those funds for longer. I'm just going to leave the tax-free cash for the moment. But what I am going to do is in the income area, I'm going to remove that level of income. And then in the cash flow allocation area, I'm going to be cleverer. And what I'm going to do is I'm going to say I'm going to actually repay debt first. I'm going to fund pensions. I'm going to fund ISAs. So just building up that sort of financial planning overlay. As I said earlier, if we really wanted to, we could get to real detail by funding kind of different amounts as we wished. And similarly, in retirement, this date needn't be retirement in the tool. We could have it for any date, but it just gives you some options. I'm not going to fund pensions, I'm just going to fund ISAs. And then investment based. So I'm just using a more financial planning orientated drawdown area. I'm then going to pick up the bottom here because I've turned off that pension income earlier. I'm just going to say, right, pension drawdown. So I'm going to go through their other assets first when they're in deficit. So cash, then ISAs, then bonds, etc. And then finally draw on the pensions. The difference that makes to the client is that they're now no longer running out of money. So instead of running out of money in their late 80s, they actually have money left at the end of the scenario. How have we done that? Well, let's have a look. Just going to go back to the original scenario where they're running out of money. Just let that work away. There we go. And just to remind you, we can see here the liabilities being repaid over time, pension funds rising up to about 560, and then that very long tail of pension income, pension drawdown. In the new scenario, we can see here that the debt's being repaid much faster. And there's the SEA hierarchy of need. They say debt should be repaid. And we can then see that we then diverted surplus monies to the pension funds. And look at the difference. All of a sudden, from 560, there's over £1 million in their pension fund. They've then taken their tax-free cash, but their crystallised funds keep rising up to this point. Why? Because we said take from other assets. Now, I've gone to an extreme view and said just take it all from the other assets, don't leave any cash, etc., etc., etc. But I think it's moving through that point of current position, planning scenario, and able to show the value. Cash flow for me is not the answer. Cash flow there is to show what your answer is. So we can see here their funds rising and then them having sufficient funds to get to the end of the scenario. Interestingly enough, if they were to die off in this area as well, we've left best part of £1 million in liquid assets in a very inheritance tax efficient environment. In fact, not only have we made their money work that much harder, but if they were to die off early, we've saved them a significant amount of tax. And that to me is why a client should pay your bill. I said we'd also look at presentation, ways of presenting this. Traditionally, cash flow has been presented on paper. Increasingly, people are actually working it live with clients. So what I'm going to do now is I'm going to go into what we call our engage view. And this is a view that allows you to manipulate the graphs, etc., very easily, very quickly, but is deliberately limited. It's deliberately limited. So within the tool, we have all the graphs that we had previously, etc., but just much easier to move around. I would start, if I was presenting live to a client, probably with the display screens. And here I've got my balance sheet. And we can see here the balance sheet. Have I included pensions? Yes. Have I included financial assets, main residence, etc.? I can include or exclude. And we can see exactly what the cash flow is built on. I can then go back and go into the statement of income. And this gives me a breakdown of the income that's being used this year and any year in the future. And similarly, with statement of expenditure. Within the display screens, there are also the CALM screen, cash flow, assets and liabilities modelling, which is a very high level inflows and outflows, total investments. So really that net worth statement for liquid assets. And the one that I would hate to have to use, but sometimes very useful, it does give you a year-by-year tax calculation. Also within the charts, we can see the calculations are there, as is death and disability graphs. So what if Fred was to die? And on this graph, we can see that's our original position, and that's what happens on death. And anecdotally, what we've seen is that firms that are using these tools, because of that ability to do a really quick and easy death scenario, you can then show your client that, yes, actually, we've done a very quick check, and yes, there is an issue on death. Is that something you'd like to review? The amount of protection business they write has actually increased. So we have those death and disability graphs, nice and clear and easy for you. So we're back here. This is where we can then make some changes to the scenario to reflect the client's position. So when the client comes back to you and says, well, actually, I'd like to retire early, so I can retire at age 56. Interestingly enough, no surprise, they go negative. They can then say, well, what happens if I downsize at retirement? So very quick and easy to do. And we can see, there we go, there's our downsize, and yes, we're there. I can then go and look at what happens if there's a market setback, and the market setback is more sophisticated than the main tool. And so we can see here, we're starting to really build a picture for our clients. And we can see they're now running out of money at the end, but they've retired early, there's been a market setback. And you can then have a discussion, a really enriched discussion about capacity for loss and whatever else as you need. Also within the Engage tool, we can move incomes and expenses, investment growth rates as we did earlier. We can change inflation. We can change capital in, capital out. So, you know, when they receive that inheritance in 10 years' time, we can reflect that. Sure enough, we can now show that they're in a much better place in terms of running out of money in their early mid-90s rather than back into their 80s. So it enables you to move that around. So that's what we call the Engage tool. It's just a different way of presenting live. The benefit of presenting live, the benefit of presenting live is that you can then make those changes, and the client engagement is greater. I will just take a moment and just run through some of the reporting that's available for you within it. So when we look at this, within here, we have the cash flow report, Smart Style. This is a training view. The Smart Style reports will enable you to put on your own fonts, your own colours, your own logos, etc. So it's very much your report. And there's a wizard in here that will take you through very simply and give you an indication of the output. This is the sort of output that you are likely to get. There's an interactive table, a bit of information there. Let's have. I'm just going to give you a full made up report. There we go. So a bit of information there as a standard pie chart of their assets and table. a current position as we saw earlier, surplus and deficit assumptions, then a second scenario we've cut in there, just run the wizard again and away we go, and then I've included just death in this one, so it could include inheritance tax, death, disability, etc. And then some next steps, and then personal information based on the scenario we've built, and some assumptions. And I think the key here, we're very, very close to releasing a new report template wizard that will enable you to very simply just type in your template rather than having to code it, which means that you can have your report rather than my version of your report, so to speak. It will also be able to allocate with multiple scenarios, multiple graphs, to just check which ones you want, which I think will give you a great deal of flexibility should you want something other than just the standard. So that's the end of the presentation for today. We have got some questions come in, so we've got a few minutes left, so I'm just going to ask the question. For phased drawdown, can the tool be set to automate this annually? Yes, so what we can say here, through the cash flow allocation, let me just get back to that. Through the cash flow allocation, we can just say, take shortfall from drawdown. That's the first part. The second part is, when we go, so let's go cash flow allocation. When the internet plays. So we can go to that basic level and just say, the first thing I want to do is to go to pension drawdown. I can then go into the deficit options and I could say pension drawdown amount 12,000 or whatever I wanted it to be. The second way of doing it is through the pension drawdown area, and in the phasing I can just put in that I want to aim for a particular income level over a particular period of time. And so what that will enable you to do is to say, right, between retirement and state pension age, I want to use a full 12,500 personal allowance as taxable, and the balance from tax-free cash. So it can be really, really flexible. So if I'm looking for the classic 22,500 income, then I can then get 10,000 from tax-free cash and the 12,500 from the crystallised funds. So I'm crystallising 40,000 at each point, and the tool will enable you to do that and set that up for you. So I hope that answers that question. If there aren't any other questions, then I'm going to close the webinar. So in terms of follow up from here, if you do have any further questions, my name, just to remind you, is John Bethell. My email address is there, john.bethell@iress.com. Please do feel free to contact me if you have any further questions, or if you want to have any further sort of information or further demonstration on the Iress Cashflow tool.